Tax planning strategies are important for minimizing the amount of taxes that you must pay. The goal of tax planning is to practice tax avoidance, which is the use of legitimate methods to reduce one's taxes. This is in contrast to tax evasion, which is the use of illegal actions to reduce your taxes. Tax evasion will cause you to pay penalties, fines, and even serve jail time if caught. Begin planning your tax strategies at the beginning of the year. Don't wait until the end of the year or near the tax filing deadline of April 15th. You will have far less opportunities to make a change in your tax situation. Also, you will need to have an idea of the amount of income or deductions that you are anticipating during the year. For example, if you anticipate making more money in the current year, you may want to accelerate your deductions for this year. This will give you more tax savings at the higher rate. Accelerating your deductions may include paying property taxes early, before the end of the year, or making charitable contributions in the current year, when they'll provide you with a better tax advantage. There are other tax planning strategies that you may want to consider, depending on your individual situation. If you own a business, you may have some flexibility in terms of deducting a portion of your home if it's used primarily for a business. Say, for example, you provide consulting services, and the primary location of your business is in your home. If you renovate your basement to be used for client meetings, you will have the opportunity to deduct some of the home expenses for this purpose as well. Also, if you are divorced and pay alimony, you can deduct this amount on your tax return. The recipient must report this as income. Child support, however, is not tax deductible. For single parents that are the primary caregiver and can claim their children on their tax return, they may qualify as a head of household filing status. This is particularly helpful because the tax due will often be lower than the single rates. Also, there are child credits and child care tax credits to consider. Another tax planning strategy may be available if you are older than 50. There are additional deposits called catch-up amounts to allow people to contribute more towards retirement and thus be able to take a tax deduction for the higher contribution, which will lower your taxes. Retirees also have varying amounts of Social Security that is taxed based upon the amount of their income. In some cases, the difference can vary between 50% and 85% being taxed. One thing to consider might be delaying the receipt of Social Security in the last year that you were employed, since 85% of the Social Security received will probably be taxed. Lastly, persons over 59.5 may withdraw tax-deferred funds from a retirement plan without any penalty. These amounts are still subject to ordinary income tax, so plan accordingly.